Yo, what's good everybody? Welcome back to another video. So in today's video, we're obviously going to be going over the entry candles part 2. So today we're going to be looking at GBP JPY on the 4-hour time frame. Now, what I'm going to be doing is specifically just looking for the patterns themselves, or entry candlesticks, right? We're going to be going over the high probabilities, the high probabilities, the medium probabilities, along with the engulfings, the variation patterns, so on and so forth. So first, I'm kind of just going to skim along the charts and we're going to literally solely look for the patterns themselves, right? Now, I may find examples of the patterns here that don't really make sense, but really when it comes down to entry candlesticks, right, you want to only look for these entry candlesticks at levels of support and levels of resistance, right? So what you want to do when you first come on the chart is mark up your support and resistance levels, which you'll learn later on, but I'm just going to kind of mark them up really quick. Here I'm going to mark up a level here. I'm going to mark a level here as well. I'm also going to mark off this area here. And we'll keep it like that for now. Along with supporting resistance levels, you could also be looking at trend based levels, right? But right now I kind of just want to focus on support and resistance. So let's kind of get started right into the video. So the very first candlestick we're going to be paying attention to is here, right? Notice how price is at resistance, meaning that when price is trading at resistance, we're going to be looking to sell. And this is going to be a bearish engulfing candlestick that is a high probability. Now, why is it a high probability? Very simple, because this candlestick closed under the lowest low of the previous candlestick, making it a bearish engulfing. Now, along with that bearish engulfing that we have here, right, notice how there is also a bearish variation pattern literally right after it. And this is a high probability bearish variation because it closed under the lowest low of the previous candlestick and the lowest low of this bullish engulfing candlestick, right? Now, typically, this would be too late to make an entry, right? Price has already moved too far away from resistance, but you could have definitely taken a more aggressive entry here. So we know that this is a level of resistance on the 4-hour time frame. Pretty much this entire zone is resistance. We know it's a level of resistance on the 4-hour time frame. What you could do is you see how in the 4-hour time frame, right, we're in resistance. Keep that in mind. You could go down to like a 30-minute time frame. And once you would have seen that doji close or that weak bearish candlestick, you go down to a 30-minute time frame. What do you see here? You see a medium probability bearish variation pattern. And then if you would have waited a little bit longer, you now have a higher probability bearish variation pattern. But you could have taken a trade solely based off of this medium probability bearish variation pattern. So you could use multiple time frames to look for your entries in that situation, which your entry would have been somewhere along here, right, compared to down here. Right, so we'll get into time frame correlation and everything else later on, but as of right now, I kind of just want to focus on the entries themselves. So notice how, again, we have resistance here, or we have support here, rejection. This is a rejection as well. Notice how this is not an engulfing candlestick, so this would not have been the best entry possible, but this right here would have been our entry right here, right? Why? Because this would have been a high probability bullish engulfing candlestick. Why is this a high probability bullish engulfing candlestick? Because price closed above the highest high of the previous candle, making it a high probability bullish candlestick, right? And if you didn't like this engulfing candlestick, you could have waited a little bit longer, avoided a little bit of drawdown, and you could have seen another engulfing literally right after that, giving you an entry off of another retest of this level of support. Why is this a high probability bullish engulfing candlestick? Simple, because price came down, engulfed, and closed above the higher high of the previous bearish candlestick. Now, one thing you can also pay attention to is this right here. This is a medium probability bullish engulfing candlestick. Look what happened right after this medium probability candlestick. Price went down and went down a lot, but came right back up after. But that is a medium probability candlestick. Now, this line right here that I have in the middle is another level of resistance. Notice how it gave us a sell signal. It gave us a nice high probability bearish engulfing candlestick. But you're not going to win every single trade. In hindsight, you'd be like, no, I wouldn't sell there, right? But if I were to press this replay button, I'd replay it from here, right? That looks like a very nice trade to take a sell off of. It looks very clean, and it looks like pricing come right back down to support. But, you know, you keep playing it, and you see that trade just simply wouldn't have worked out. But you know what could work out? It was, I mean, I skipped a little bit too fast. There's a break above. Notice how price came back down into support, rejected support, and then gave us another entry to buy right here, a high probability bullish engulfing candlestick. And look what happened right after that. Price kept going up, which you could target this high all the way up there. Let's see if that would have been hit, and it was. Right now, look at this. Resistance is now being rejected. Right, what do we have here? A high probability bearish variation pattern. Why did you say high probability bearish variation pattern? Because price closed under the low, or price closed under the lowest low of the previous candlestick. So here's another entry signal, right? A bearish variation off of this level of resistance. What could you do now? You could target the next level of support, which is down here. Let's see what would happen if you would have taken that trade, right? Price would have hit your level of support pretty nicely. I mean, you can even continue it, see how it plays out. Now, notice all of the rejections here, right? Let's see what kind of happens in this situation, because right here you have a high probability bullish engulfing candlestick rejecting this level of support. If you would like to, you could definitely take a buy back up into this range, but just know price is overall moving sideways. So it's kind of like a situation where it could go either way when price is moving sideways. Like this, and now there's a big bearish engulfing candlestick, right? So let's see what would have happened here, right? So in this situation, it actually would have played out in your favor if you would have bought in there, right? But again, we're kind of looking at things when we already know what's happened in the future. But again, trading is a game based off of probabilities and probabilities only. So this is actually another entry candlestick here. This is a variation pattern right here. As well. Notice the rejection, right? A pullback, and then notice how this bullish candlestick did not end up closing under the lowest low, obviously, right? But the candlestick right after that closed under the lowest low here. All a bearish variation is if price doesn't give us an engulfing, then we wait for multiple candles to pretty much close under the lowest low of one of the previous candles to actually take a sell, right? So in this situation here, we have a big bullish candlestick. This candlestick didn't engulf. This candlestick didn't close under the lowest low of the previous candlestick, but this candlestick here closed under the lowest low of the previous candlestick there. So this is a bearish variation, and you could definitely take a sell from this bearish variation. You could look to take price down to this level of support or down to this level of support, all the way down there. So let's play it out, see what would have happened, right? You're still holding, because again, when you actually take a trade, right, price, your stop loss has to go above resistance, which is somewhere up here above these highs. So you would still be in the trade, right? But let's look for more entries to see if you could have possibly added more entries there. So this wouldn't have been a good entry here, because notice there is no variation pattern. Why is that? Because this candlestick did not close under the lowest low of this candlestick. This candlestick didn't either. This candlestick did not close under there either. Neither did this one, neither did this one. This one didn't either. This one didn't either. But this one would have been another bearish variation. Why is that? Why? You have to ask yourselves now. Why is this considered a bearish variation and none of these here are? It's simple. We're looking at the previous candle when it comes to a bearish variation, right? So notice how this candle didn't close under the lowest low of this candlestick, which again, going back to the previous lesson of the candlestick anatomy, right? The lowest low is going to be the lowest point the wick went down to. Notice how this candle didn't close under the lowest low of this candle. This bullish candlestick here didn't close under the low of this bearish candle. This bearish candle didn't close under the lowest low of this bullish candle, so on and so forth. But this candle did close under the lowest low of this candlestick here, right? And now notice how you have the variation pattern. You could have taken a sell right then and there as well, and then put your stop loss above resistance. Why? Because the sell is still valid. And let's see what would have happened. Right, so again, the targets in the situation would be this support right here or this support right here, right? So let's continue. So we've broken under that support. You could have potentially closed one position there. And then here is another entry where you could have taken another sell. Why is that? We have resistance throughout this range here. If I can just extend this, you will see a little bit better. Right, notice how price came up to resistance and gave us another bearish variation pattern there, right? The most frequent candlesticks you're going to see are bullish engulfings and bearish variations, right? And again, these were high probability. This one was a high probability. This one was a high probability. This one was a high probability. These were all high probability entry candlesticks, right? Why is this a bearish variation? Simple. It closed under the lowest low of the previous candlestick there. And let's kind of continue. As you can see, price is pretty much going all the way back down to support, and it's hit our target. Now that we're at resistance, right, this could be an entry for an aggressive position, right, with your stop loss under support, maybe somewhere down here, right? This would be an aggressive entry point here, medium probability, right? And as you can see, right, momentum is slowing down, so this could have been another entry for an aggressive position. But you have to keep in mind, if you didn't take the entry here, you could have taken it there. This is for your more aggressive traders. And then here you go. Here you have the bullish engulfing candlestick. So essentially you would buy right here, put your stop loss somewhere under support, and targets would be the next two resistance levels being here and all the way up here, right? So this is where you would enter the market, right then and there, right when this engulfing candlestick closes, and then you wait it out. Remember, just because you enter the market after an engulfing candlestick pattern doesn't mean that price will go in your favor right away. But price does have a higher probability of showing you that price is going to continue to go up in a situation where you bought after a bullish engulfing, simply because it shows us that there are more buyers in the market trying to take over at that level. So let's play this out, see how this would have played out here. And again, keep in mind now, here we have a bearish variation pattern, right? What I said in the beginning of the lesson, ask yourselves, right? What did I say in the beginning of the lesson? It's simple. It's not about the what, but more about the where. Just because you see a random engulfing or a random bearish variation doesn't mean that it's going to play out in your favor. Again, we're only looking to take trades at areas of support and at areas of resistance, which here you go. Here you could have potentially taken another entry, but this would have been a medium probability setup. Why? Because this candle didn't close above the highest high of this previous candlestick here, right? So remember, when it comes to selling, right, we're looking for the engulfing or the variation to close under the previous candle's lowest low. Just put together selling, lowest low, buying, highest high, because we're looking for price to make higher highs. Just put those two words together and let's continue. Let's see what would have happened. So here price is approaching the first target, and here prices hit the first target, right? Let's see what happens, right? Momentum slowing down, and here you have a medium probability bearish engulfing, which you could take a sell from, but again, we're still looking to maintain our buy positions. Now, I'm not gonna go in depth right now into time frame correlation and whether you should hold a trade or not hold a trade, but just keep those things in mind, right? So let's continue. Here it is. Here's another. This is a bullish variation pattern. Is it a medium probability? No, it is a high probability, but let's actually measure the candlestick to see where it closed at. So it closed around the 50%. So it's a pretty neutral candlestick. But here's another entry to take a buy from. If you would have taken a sell here, sure, you would have made money on this sell here, right? But again, when I'm looking to buy a certain position, I'm not looking to sell right after, especially when I just closed the trade up here, because remember, that's our first target, right? Let's continue. Okay, this is a little bit of a different story, right? Notice the first rejection, notice the second rejection, and a bearish variation. You could take a sell based off this bearish variation pattern. And let's see if that would have actually played out. So again, price is starting to consolidate now, and it's forming a bullish wedge. So it's not worth holding that position, and I probably would have closed this position at a little bit of drawdown if I'm taking the trade here. But we're not looking to take specific trades. What I'm looking for are entry candlesticks. Was this a valid entry for a sell? In theory, yes. Why? Simply because we rejected resistance, or price rejected resistance, and gave us a bearish variation pattern. So yes, that was a valid sell. Would it have worked out? No, and that's going to happen in the markets, right? Not every trade is going to work out, and you're going to need to learn when to cut your losses, and you're going to need to be okay with taking losses. If you're not okay with taking losses in trading, then trading just simply isn't for you, and you're only going to get better with taking losses with time. Now, keep in mind, here we have resistance. Notice the break of resistance. Notice the retest, how price came right back down to resistance. Resistance is now holding a support, and we have a bearish or a bullish variation pattern. Could we take a buy? 100%, most definitely. Ask yourselves, where could we take a buy up to? We would close the trade in profit somewhere up here, right? So again, we have another entry. This is a bullish variation. This is a high probability bullish variation as well, because it closed above the highest high of the previous candle. So let's see how well this trade would have played out. So it did go in our favor pretty much almost right away, but now it's pulling back to about entry. And here's another entry, right? This is a medium probability candlestick. Why? This is a medium probability engulfing. Now ask yourselves again, why? Simply because this candlestick did not close above the highest high of the previous candlestick. So it's a medium probability. So on this trade, hey, instead of me risking my usual 2% or 3%, whatever you normally risk, I'm going to risk maybe 0.5% or 1%. Let's see what would have happened. You see when I don't know what I just said there, but you see what I mean by a medium probability versus a high probability, right? Price didn't go down. Price didn't go in your favor right away, and it actually pulled back on you a little bit. Yes, you would still be in the trade because your stop loss has to go under support. But now look at this. We have a medium probability bullish variation pattern, because it still closed above the close of the previous candle, but it didn't close above the high. So we have two medium probability candlesticks here, or entry candlesticks here. Didn't close above the highest high. Let's see what would have happened. Price is pulling back, and now you actually have a high probability sell here. So could price actually sell off and break resistance? I would say the probability is a lot higher, yes, because when you see two medium probability candlesticks versus two very high probability sell candlesticks, right, price could go down, especially with price consolidating like this, just moving sideways. There's no real trend in direction. But I wouldn't take that trade simply because we're still trading above support. Now we have a high probability buy opportunity here. So this would be the best time to actually buy. Now I'm saying that in hindsight because I'm not actually taking these trades, and I'm actually waiting, right? Could I have taken a trade here? Possibly, yes. Could I have taken a trade here? Possibly, yes. The one thing that both of those entries would have had in common is a stop loss, which a stop loss has to be down here under support. So it doesn't matter if you would have entered here, here, or here. Everybody's stop loss would have to be here under support to be safe, right? And then this position, as you can see, went into profit pretty much right away, right? And we can also, incorporate things like, hey, you have break-even stop losses and whatever the case might be, is where you don't lose money. Yes, that is very true. In a situation like this, you probably would have been broken even, or maybe even would have taken some profit. It really, it depends on the trade itself. But again, I'm trying to focus more on the setups, right? I'm trying to focus more on the entry technique here, which right now what I'm helping you guys do is build that pattern recognition. So here, perfect. We have a break under support, a pullback to support, now holding as resistance. We have a very nice, very clean bearish engulfing. high probability, right? In a situation like this, you would take a trade here, your stop loss could go there, and then your take profit would be support down here. You can actually have a smaller stop loss. You don't have to have one that's that big. So with a 3-to-1 risk to reward ratio, you could risk $1,000, look to make $3,000, and that's a high probability trade. And it's up to the trader to determine what type of risk they want to use on that trade, right? And again, notice how price didn't go in our favor immediately. This is why we set stop losses in certain areas that we know if, hey, price, my stop loss is going to be up here, right? If price is going to hit my stop loss, then I'm most likely wrong and I want to get out of the trade, right? But notice how in this situation here, it would have definitely pulled back, yes, but then it would have continued in your favor. And in situations like this, you could always just re-enter the market. Why? One, because the trade is still valid. Now, keep in mind, I'm not looking at trading times or anything. I'm just kind of looking at the entry signals themselves, right? I'm looking at the candlestick formations here. So there's one entry here, there's no entry here, and there's one more entry right here with this big engulfing candlestick, right? Targets will be support all the way down here. As you can see, that was pretty much hit right away. Now, keep in mind, momentum and the high probability entry. Why is this a high probability setup? Well, simple, because it closed under the lowest low of the previous candlestick, and it's an engulfing pattern. Now it's hit support. What do we do at support? If support holds, we'll look to buy. Here is a high probability bearish variation pattern, yes, but in situations like this, you could take an entry right away. It would be a little bit more of aggressive. It's a mix between a conservative and an aggressive entry, yes, because look at one momentum. So what you could do is wait for price to come back down and try and retest it, such as this, right? So let's wait. And right there, you could have taken an entry here as well. Remember, we also have our market structure patterns, double tops, double bottoms. Let's see if we get an engulfing, right? We're still waiting. And here we have a high probability bullish engulfing. This is where you would take your buy position, you buy right here, stop loss under the engulfing. Targets could be support, resistance 1 or resistance 2. This is going to be a 4.47 risk reward ratio, meaning I'm risking $1,000 to make 4.4K, right? Pretty simple math there. And again, we have to trust in our position. Once we see our entry signal, it's okay. I'm entering the market, I'm setting my stop loss, I'm setting my take profit, I'm going to monitor it. Do not try and close your trade early. Try not to tamper with your trade and sit on your hands as best as possible. Because what happens when you start closing trades early and then getting back in right away when you see it going in your favor is you slowly start paper cutting your account until you see, damn, you know, I won the trade, it hit my target. I made $1,000 on this trade, but I closed $100 like 8 times and really only netted $200. And that's happened to me a lot in the beginning, and it's just emotional control, right? And let's just kind of play this through. So it hit our first target, and definitely by this point you would have already been out of the trade, right? But you guys should get the point by now. I don't want to make this video too long. Repetition. Again, guys, what I want you guys to do is go look at the previous lesson again, go on your actual chart and look for all of these examples, right? Look for your support and resistance levels and just look for the engulfing patterns, the variation patterns. Look for your pin bars, look for your 3-bar reversals, right? Look for all those patterns and send them in the chat. Get some community feedback and tell everybody what you think with your high probability entry candles, with your medium probability entry candles, so on and so forth. So I'll talk to everybody in the next lesson.